Welcome, curious listeners, to Curious Potential, the podcast where we explore the fascinating intersections of self-improvement, life skills, and unlocking your best future. I'm your host, Sophie, and today, we're diving headfirst into a topic that is absolutely foundational to building that secure and thriving future we all aspire to: improving your financial literacy. We're calling this episode Money Matters because, let's be honest, it really does. In a world where financial decisions are a daily occurrence, whether it's deciding what groceries to buy, planning your next big purchase, or perhaps the monumental task of saving for retirement, understanding the basics of personal finance isn't just helpful. It's genuinely essential for peace of mind, reducing stress, and ultimately achieving your biggest goals. Many of us feel overwhelmed by jargon, intimidated by numbers, or simply unsure where to start when it comes to managing our money. But it doesn't have to be that way. Today, we're going to demystify personal finance by breaking down some of the most basic, yet crucial, financial concepts into easy-to-understand language. We'll provide you with actionable, practical steps to create a working budget that actually works for your life, not against it. And perhaps most importantly, we'll explore how to develop healthy, sustainable money habits that will serve you well for years to come. Our aim here at Curious Potential, especially in this Money Matters episode, is to equip you, our amazing listener, with the knowledge and tools you need to take absolute control of your financial destiny, reduce that nagging money-related stress, and steadily build wealth over time. So, if you're ready to transform your relationship with money and feel more confident about your financial future, then you are in the right place. Let's dive in. Welcome back to Curious Potential, where we're uncovering the secrets to a richer, more fulfilling life, starting with our finances. Last time we set the stage, now it's time to lay the foundation. Before we can build that strong financial house, we need to understand the absolute basic building blocks. Think of it like learning your ABCs before writing a novel. Let's kick things off with income and expenses. Sounds simple, right? And in essence, it is. Your income is all the money flowing into your life, your paycheck from work, revenue if you run a business, that side hustle income, or even unexpected gifts. It's the fuel that powers your financial engine. Conversely, your expenses are all the money flowing out. This covers everything from your rent or mortgage, groceries, utilities, transportation, and yes, even that daily coffee or streaming subscription. While these definitions are straightforward, the real magic and the bedrock of financial management lies in meticulously tracking both. Knowing exactly where your money comes from and, crucially, where it goes is the first, most powerful step towards financial clarity and control. Moving on, let's talk about two concepts that help us define our financial snapshot: assets and liabilities. An asset is something that either puts money in your pocket or has the potential to grow in value over time. Think of investments like stocks or bonds, real estate that you own and perhaps rent out, or even your skills and education that allow you to earn a high income. These are things that enhance your wealth. A liability, on the flip side, is something that takes money out of your pocket. It represents a debt or an obligation. This includes things like your mortgage, a car loan, or credit card debt. It's money you owe to someone else. Understanding the clear distinction between what you own, your assets, versus what you owe, your liabilities, is vital. It helps you calculate your net worth, a true measure of your financial health, and empowers you to make smarter decisions about acquiring things that truly build wealth versus things that drain it. Now let's dive into a concept that is absolutely fundamental to both saving and borrowing: interest. You're going to encounter two main types, and knowing the difference is key to leveraging its power. First up is simple interest. This is the most basic form, calculated only on the initial principal amount of a loan or a deposit. Imagine you borrow $1,000 at 5% simple interest for 1 year. You'd pay $50 in interest regardless of how long you've had the loan. It's a straightforward calculation and it stays fixed based on that initial amount. Simple, right? But while simple interest is easy to grasp, the real financial game changer, the concept that truly separates casual savers from savvy investors, is its more sophisticated cousin: compound interest. Compound interest, my friends, is what many financial experts call the eighth wonder of the world, and for good reason. Unlike simple interest, compound interest is interest on interest. It's calculated not just on your initial principal amount, but also on all the accumulated interest from previous periods. Let that sink in. Your money earns money, and then that money starts earning money too, creating a powerful snowball effect. This is why starting to save and invest early is so crucial. Over time, compound interest can make your savings and investments grow exponentially, turning small, consistent contributions into substantial wealth. But here's the flip side. This same incredible power can make debt, especially high-interest debt like credit cards, snowball out of control just as quickly. Understanding its dual nature, a force for incredible growth and a pitfall for unchecked debt, is absolutely crucial for your financial journey. Next, let's talk about a silent erosion of your wealth, inflation. You've probably heard the term, but do you truly grasp its impact? Inflation is simply the rate at which the general level of prices for goods and services is rising, and as a direct consequence, the purchasing power of your currency is falling. In plain English, your money today buys less than it did yesterday, and it will buy even less tomorrow. That $5 coffee you bought last year might be $5.50 today. This isn't just an abstract economic concept, it has very real implications for your financial future. It's why simply saving money in a low-interest bank account might not be enough to preserve its value over the long term. If your savings aren't growing at a rate equal to or greater than inflation, you're actually losing purchasing power. This highlights why smart investing, aiming for returns that outpace inflation, is so vital for long-term wealth preservation. Now let's tackle a commonly misunderstood topic, debt. For many, the word debt immediately conjures negative images, and yes, it can be a trap. But it's crucial to understand that not all debt is bad debt. In fact, there's such a thing as good debt. Good debt is typically an investment in your future, something that has the potential to increase your net worth or your earning potential. Think of it like this: a mortgage on a home in a good area that appreciates in value over time. While it's a debt, it's also an asset that grows. Student loans, while they might feel burdensome, are often considered good debt because they invest in your education, which in turn can significantly increase your earning potential throughout your career. Even a business loan, used wisely to grow a profitable venture, falls into this category. The key here is using borrowed money to acquire or enable something that builds future value. On the other side of the coin, we have bad debt. This is usually high-interest debt used to purchase depreciating assets or consumables, things that lose value quickly or are consumed without building lasting wealth. The classic example here is credit card debt for everyday spending, especially if you're only making minimum payments. That new pair of shoes or that fancy dinner doesn't increase in value. In fact, the interest you pay means you're paying significantly more for it than its initial price. Similarly, a loan for a brand new car that immediately loses a significant portion of its value the moment you drive it off the lot is often considered bad debt. These types of debts drain your financial resources, offering little to no long-term return. The goal isn't necessarily to avoid all debt, but to manage it wisely, distinguishing between what builds your future and what simply costs you money without a tangible return. Finally, let's talk about your credit score. This isn't just some arbitrary number. It's a 3-digit representation of your creditworthiness, a financial report card that lenders and others use to assess your risk. It's built by consistently demonstrating responsible borrowing and repayment over time, things like paying your bills on time, keeping your credit utilization low, and not taking on too much new debt at once. A good credit score is incredibly powerful. It can unlock better interest rates on loans, whether for a car, a home, or even personal loans, saving you thousands of dollars over the life of that debt. It can influence your insurance premiums, impact your ability to rent an apartment, and even be a factor in some job applications. Think of it as your financial reputation. Nurturing a strong credit score is a crucial step towards opening doors to better financial opportunities and achieving your curious potential. Alright, so we've established the why behind taking control of our finances. Now let's dive into the how. We're moving from theory to practical application, and that brings us to the blueprint for financial success, mastering budgeting. I know, for many of you, budgeting might sound like a 4-letter word. It conjures images of restriction, deprivation, or a financial diet, but I want you to reframe that thought. Instead of a diet, think of budgeting as your personal financial blueprint. It's not about what you can't do, it's about giving you control, bringing incredible clarity to your financial picture, and most importantly, helping you intentionally direct your money towards your goals. So how do we start laying out this blueprint? The very first step, the foundation if you will, is to track your income. And when I say income, I mean your net income. This is the money you actually take home after all taxes, deductions, and contributions have been made. It's your real, spendable cash. Once you know your exact take-home pay, the next crucial step, and often where many people get a bit tripped up or discouraged, is to meticulously track your expenses. For 1 to 2 months, I want you to become a financial detective, recording every single penny you spend. Don't worry about judging it right now, just record it. Whether you prefer a classic notebook, a simple spreadsheet, or one of the many fantastic budgeting apps available today, the tool doesn't matter as much as the dedication. This isn't about shaming your spending habits. It's purely about gaining awareness. You need to see where your money is actually going. After you've gathered this raw data, the next logical step is to categorize your expenses. You'll quickly notice patterns. Some expenses are fixed, meaning they're generally the same amount each month. Think rent, mortgage payments, or loan installments. Then you have variable expenses. These fluctuate, like your groceries, dining out, or entertainment. And finally, don't forget the periodic expenses. These pop up less frequently but need to be planned for, such as annual insurance premiums, car maintenance, or even holiday gifts. With your income and all these categorized expenses laid out before you, it's time for the analysis and adjustment phase. This is where the magic really starts to happen. Take a good, honest look. Where can you cut back? Are there any spending leaks you weren't even aware of? Is the budget you're envisioning realistic for your lifestyle and goals? Remember, the goal here isn't immediate perfection. It's about making consistent progress. It's about empowering yourself. To help you in this analysis and adjustment, there are several popular budgeting methods that you might find incredibly helpful, depending on your personality and financial situation. One of the most widely recommended and excellent starting points is the 50/30/20 rule. It's straightforward. 50% of your income goes towards needs. That's your housing, utilities, transportation, and essential food. 30% is allocated to your wants, things like dining out, entertainment, subscriptions, hobbies, and shopping. And then, a crucial 20% is dedicated to savings and debt repayment. It's a fantastic guideline that helps ensure you're prioritizing your future while still enjoying the present. Another powerful method is zero-based budgeting. This approach is exactly what it sounds like. Every single dollar of your income is given a job. You allocate every dollar to a category, whether it's a bill, savings, or a discretionary expense, until your income minus your expenses equals zero. This method forces incredibly intentionality with your money, ensuring you know exactly where everything is going. And for those who prefer a more tactile, hands-on approach, there's the classic envelope system. This involves allocating physical cash into different envelopes for your variable spending categories, like groceries, entertainment, or dining out. Once an envelope is empty, you're done spending in that category for the month. It's a brilliant way to visually manage your cash flow. Whatever method you choose, whether it's the 50/30/20, zero-based, the envelope system, or a hybrid, the most crucial element for success is consistency. Stick with it even when it feels challenging. And finally, no budget, no financial plan is truly complete without what I consider non-negotiable, an emergency fund. This is your financial safety net, designed to protect you from life's unexpected curveballs, be it a sudden job loss, a medical emergency, or a major car repair. The goal is to save 3 to 6 months' worth of your essential living expenses and keep this money in an easily accessible, separate savings account. This fund is your shield, preventing you from having to dip into debt when life inevitably throws you a surprise. Building this fund should be a top priority alongside your regular budgeting efforts. Welcome back to Curious Potential. We've talked about understanding financial concepts and creating a budget, which are absolutely essential first steps. But let's be honest, knowing what to do and actually doing it are two different things, right? True financial mastery, the kind that genuinely transforms your future, comes from embedding healthy money habits into your daily life. It's like exercise or healthy eating. Consistency is absolutely key. Without consistent habits, even the best intentions can falter. So, how do we build that strong financial foundation? Let's dive into some powerful habits you can adopt starting today. First up, and perhaps one of the most powerful habits you can adopt, automate your savings and investments. This is the classic pay yourself first principle brought to life. Set up automatic transfers from your checking account to your savings, your retirement accounts like a 401(k) or IRA, or even your investment portfolios, to happen automatically each payday. Why is this so effective? It removes the need for willpower. You don't have to remember to save or decide if you can afford it after all your other expenses. The money is moved before you even see it, ensuring you're consistently building your financial future without having to think twice. It's a game changer. Next, let's talk about something that can seriously derail your progress. Prioritize high-interest debt repayment, those credit cards with 20% interest rates or more. They're like a financial black hole, effectively eroding your wealth faster than you can build it. make it a priority to tackle them. There are two popular strategies here, the debt avalanche and the debt snowball. With the debt avalanche, you pay off the debt with the highest interest rate first, which saves you the most money in the long run. The debt snowball, on the other hand, focuses on paying off the smallest balance first for those psychological wins, giving you momentum. Both are effective. Choose the one that motivates you most to stay the course. The key is to pick one and stick with it. Another crucial habit is to make regular financial check-ins. Financial planning isn't a one-and-done deal. At least monthly or quarterly, sit down and review your budget. How are you doing? Are you sticking to it? Check your progress towards your financial goals. Are you on track for that down payment, or are you falling behind? Look at your investments. Life changes and your financial plan needs to adapt with it. It's a living document, not a static one that sits in a drawer. These check-ins allow you to course-correct and ensure you're always aligned with your objectives, which brings us to another critical habit, setting clear financial goals. Setting clear, compelling financial goals is incredibly motivating. What do you truly want your money to do for you? Do you want to save for a down payment on a house, fund a child's education, travel the world, or retire comfortably by a certain age? Make your goals smart, specific, measurable, achievable, relevant, and time-bound. For example, instead of save money, try save $10,000 for a house down payment in the next 2 years. This clarity gives purpose and direction to all your financial efforts. It turns abstract saving into tangible progress, making it easier to stay motivated through the ups and downs. Moving on, another habit to cultivate is to avoid impulse purchases. We've all been there, right? That shiny new gadget, that amazing sale item. Before making a non-essential purchase, give yourself a cooling-off period, 24 hours for smaller items, or even a week for larger ones. This pause allows you to differentiate between a true need and a fleeting want. Often, after a little time, the urge passes, saving you from buyer's remorse and unnecessary spending that could have gone towards your goals. It's a simple trick, but highly effective in protecting your wallet. Fundamentally, strive to live below your means. This is arguably the core principle of wealth building, a habit that underpins nearly all others. Consistently spend less than you earn and use that surplus, that difference, to save, invest, and pay down debt. It sounds simple, but it requires discipline to avoid lifestyle creep, where your spending increases proportionally with every raise or income boost. Resist the urge to inflate your lifestyle just because your income grows. The more you can maintain a gap between what you earn and what you spend, the faster you will build true financial security. Finally, make continuous financial education a lifelong habit. The financial landscape is not static, it's always evolving with new products, regulations, and market conditions. Read books, listen to podcasts like this one, follow reputable financial news sources, and stay informed. The more you know, the better equipped you are to make informed decisions, adapt to new challenges, and seize opportunities. Your financial education is an investment in yourself, an investment that will pay dividends for years to come. By consistently practicing these habits, you're not just managing money. You're building a robust and resilient financial future. And that brings us to the end of our deep dive into improving financial literacy here on Curious Potential. We've covered a lot of ground today, haven't we? From laying the foundation with fundamental concepts like understanding your income versus your expenses, distinguishing between assets and liabilities, grasping the impact of interest and inflation, to navigating the complexities of debt and the crucial role of your credit score. These aren't just abstract terms, they're the building blocks of your financial world, and knowing them is the first step towards mastering it. Then we moved on to practical, actionable steps you can take right now. We talked about creating a budget, exploring effective methods like the straightforward 50/30/20 rule or the meticulous approach of zero-based budgeting. And of course, we underscored the absolute necessity of building and maintaining a robust emergency fund, your financial safety net. But beyond the numbers and the rules, we delved into cultivating healthy, sustainable money habits. Automating savings to make it effortless, prioritizing debt repayment to free up your future, setting clear, measurable financial goals, and committing to continuous self-education. Remember, financial literacy isn't about being perfect or knowing every single detail. It's fundamentally about being informed and taking consistent, intentional steps forward. Every significant financial journey, just like any other, truly starts with a single step consciously taken. So, as we wrap up this Money Matters episode, I genuinely encourage you to pick just one thing from today's discussion and implement it this week. It could be as simple as beginning to track your daily expenses for the first time, setting up an automatic transfer of a small amount to your savings account, or perhaps dedicating an hour to educate yourself further on one of the specific concepts we touched upon that piqued your interest. The power to transform your financial future, to move from potential to tangible progress, is truly within your hands. Thank you so much for tuning into Curious Potential. We sincerely hope this episode has empowered you, not just with knowledge, but with the confidence to take control of your financial journey. Join us next time for more insights into building a healthier, wealthier life, not just financially, but holistically. Until then, keep learning, keep growing, and most importantly, keep making your money matter.